Wealth and Inheritance, a compelling story of how some of Britain's richest estates face staggering tax bills that often catch families off guard. But here's where it gets controversial. While London's wealthiest neighbourhoods top the charts for inheritance tax, IHT, surprising areas outside the capital are also making the list. The most recent data analysis from Irwin Mitchell Private Client Advisory, based on the government's 2022-23 figures, reveals that London's poshest districts dominate the rankings for the highest average IHT paid per estate. At the pinnacle is Kensington, where estates fork out an eye-watering average of £1,375,000 each in inheritance tax. Close behind are Chelsea, Fulham, and cities of London, Westminster, both exceeding £1 million on average. However, this isn't just a London phenomenon. Contrary to what many might assume, two areas beyond the capital's bounds, Altrincham Sale West in Greater Manchester and Torridge West Devon, have secured spots in the top 10. Their estates pay substantial taxes as well, averaging £451,220 and £534,247 respectively. This highlights how wealth, and consequently hefty tax obligations, are spread beyond London's exclusive postal codes. Here is the detailed top 10 list of UK locations with the highest average IHT paid per estate for the 2022-23 period. 1. Kensington, £1,375,000. 2. Chelsea and Fulham, £1,114,583. 3. Cities of London and Westminster, £1,075,949. 4. Hampstead and Kilburn, £717,949. 5. Westminster North, £647,059. 6. Finchley and Golders Green, £562,842. 7. Wimbledon, £556,452. 8. Torridge and West Devon, £534,247. 9. Islington South and Finsbury, £406. Altrincham and Sale West, £451,220. Andrea Jones, National Head of Irwin Mitchell's Private Client Advisory Team, explains, "Our study highlights the critical need for early and strategic estate planning, especially in regions with high-value properties. With property prices climbing and asset portfolios becoming more complex, managing inheritance tax exposure is increasingly challenging. Professional guidance is vital to help families safeguard their wealth and pass it on efficiently." This analysis is part of Irwin Mitchell's broader examination, the Inheritance Tax Revolution Report, which delves into how IHT is evolving across the UK. The report draws on 7 years of data from 121 postcode areas and predicts a rise in estates liable for IHT from 4% to 7% by 2028. Intriguingly, it forecasts that Greater London's overall IHT bill could soar by 54%, reaching £2.6 billion annually. But the plot thickens with recent governmental reforms. Chancellor Rachel Reeves, in the autumn budget of November 2024, unveiled significant changes to inheritance tax rules, shaking up reliefs that estates have long relied upon. From 6 April 2026, Business Property Relief, BPR, and Agricultural Property Relief, APR, both previously offering 100% relief on qualifying assets, will be capped at £1 million. Assets above this threshold will only receive 50% relief, marking a dramatic shift in how large business or farming estates are taxed. And it doesn't end there. Starting 6 April 2027, pension funds and death benefits that had previously been excluded will now be subject to IHT. The government released draft legislation on July 21, 2025, explaining that personal representatives, executors managing estates, will be responsible for calculating and paying tax on pension assets. Even though they may not have direct access to these funds, Irwin Mitchell's experts have voiced serious concerns. They warn that these reforms could create a minefield of legal and emotional complications. For example, if pension beneficiaries differ from those who inherit the rest of the estate, executors might have to dip into estate assets, such as the family home, to cover the inheritance tax, and then attempt to recover these costs from pension beneficiaries who are under no legal obligation to repay. This friction could lead to bitter disputes and make the already complex task of estate administration even more stressful. This raises an important question for families and advisors alike. How can one adequately prepare for an inheritance tax landscape that's becoming more complicated and controversial? Are these tax changes fair? Or are they creating unnecessary hurdles for families trying to preserve their legacy? We'd love to hear your thoughts. Do you agree with these reforms, or do you think they go too far? Join the conversation and share your perspective in the comments below.